In this video, we discuss why many people believe that the Consumer Price Index, or CPI, doesn't reflect true inflation. Coming up next on Holy Schmidt.
Holy Schmidt!
Last Wednesday, the Consumer Price Index was released for June 2022, and it came in at 9.1% annualized. This is a number that was higher than most people expected, including me, frankly. There are a lot of reasons this came as a surprise. The markets didn't expect it either, by the way. But the biggest reason, at least for me, was that the Fed raised interest rates by 75 basis points about 6 or 8 weeks ago, and this was the highest raise since 1994, November of 1994 to be exact. And also, if you talk to most people, it does appear as if they're spending less. So why did CPI come in higher than expected, and is it measuring the right basket of products and services that people buy and use? Let's start off with an analogy. As I mentioned in my last video, I'm vacationing here in Long Beach Island, LBI. And if you were here 12 months ago, which we were, the mood on the island was frantic. People had just been freshly vaccinated and they wanted to regain their lives. So they were out spending a lot of money, going out to restaurants, renting boats, renting really nice houses. And in fact, they were trying to make up for the 24 months that they had been in quarantine. It felt almost as if they were doing it all in one spot here in LBI. By the way, because we're filming in LBI and I'm on vacation, this is why I'm wearing a golf shirt and a fitness band. I don't normally wear a golf shirt. As you know, I wear a suit, but I always do wear the fitness band. It's just underneath the suit. And for reference, there's no paid product placement for the company that makes the golf shirt or the fitness band. I just like the golf shirt and I always wear this fitness band. What I like about LBI is that it's a microcosm of the world on vacation. If you go out in the morning and you go up and down the main road, it's called LBI Boulevard, you often see 12-year-olds riding in groups on their bikes without their parents. People are very respectful of the bikers. They're driving very slow. It feels like the world as it was about 30 or 40 years ago. People who come to this island come from different socioeconomic classes. In short, if this was a place where you were trying to see if it would work or a movie would sell, it would be Peoria. I want to take you back 12 months because this is completely relevant to what I have to say here. If we go back 12 months, restaurants were impossible to get into. You'd have to make reservations weeks in advance. And people were out and about late in the evening. They were partying like it was 1999. But this year it's different. If you go into a restaurant later in the evening, you can always get a table. If you call during busy times, 7 to 8:30, you may get lucky and they may have a cancellation and you can get right in. Outside of LBI, there are also telltale signs. 1 out of 7 home buyers are canceling their homes, 15%. That is a big number. That stat just came out a few days ago. People are carpooling more. According to a poll I ran right here on YouTube, 9% of the respondents are carpooling. Now that doesn't sound like a big number until you realize that about half of the channel are people in retirement, half the people who watch this channel. So the respondents would be from that population. Importantly, CPI is the economic release that determines the cost of living adjustment for Social Security, CPI-U anyway, which is effectively the same thing. And that number, if it was manipulated down, would in fact lower the cost of living adjustment that people receive at the end of every year. And for completeness, every time I release a video on the cost of living adjustment, what it could look like in the future or what it did in the past, there's always a few comments, even more than a few in many cases, about how that number is lowballed and how it is manipulated. This seems like a good place to address this point, because if you look at it a certain way, an argument could be made that CPI underrepresents what is happening with inflation. The Consumer Price Index has been around in one form or another since about 1919, and at one point the items in the basket were fixed. If a bottle of Coca-Cola was in the basket, that bottle would never leave, so you could track the price of that bottle over decades, in fact. If the basket contained filet mignon, 93 octane gasoline, and Stan Smith Adidas shoes, it would contain all of these throughout time. But somewhere along the way, someone decided that the basket should reflect what people are actually purchasing, not what things cost. This made sense because things go in and out of fashion sometimes, or in and out of availability. If, for example, you tried to buy a new car during World War II, you couldn't purchase a new car. You also couldn't purchase a washing machine, so if you had either a new car or a washing machine in that basket, it would be basically useless. And frankly, if nothing else, it would have skewed the results way up. So along the way, the government decided that CPI should reflect what's called a constant standard of living, meaning what people are actually purchasing, not what things cost. And here's the point where the skeptics might have a point. If CPI represents what people buy, they buy differently during inflation than they do during good times. As you can imagine, this would make it very easy to manipulate the data if one chose to do so. One of the first to call this out was an economist named John Williams. John said that this methodology drastically understates inflation because we could all find a way to spend less if we needed to do so. If you live in New York, you could move to Nebraska and your rent would go down. More realistically, imagine if the basket contained filet mignon and boneless New York strip steak. For you beef eaters out there, you'll note that both are very good, but filet mignon is generally considered to be better. Let's assume that filet mignon costs $14.70 a pound and New York strip costs $9.62 a pound. By the way, according to the USDA, these are the actual average prices for the week of July 7th through July 14th, 2022. Things get a little tough. Gas prices are going up and you don't have a lot of expendable income, so you decide to opt for the New York strip steak instead of the filet mignon. Each pound of your new steak is $5 less expensive than your old steak, so theoretically you are saving 1/3 on your expenses, at least when it comes to beef. And by the way, you switch from 93 octane gasoline, often called nitro for your American sports car, down to 91 octane. That saves you 15 cents a gallon. And you buy about 100 gallons a month, so that's $15 a month. You decide that Coca-Cola is too expensive, so you switch to the store brand. That saves you about 30 cents a can. And well, you decide you're going to keep the Stan Smiths because they're just cool and you're not going to give everything up. So if every item in the basket went up last year, but you switched to something less expensive, your actual costs could go down. Now imagine if it's not just one person, but it's millions, tens of millions, hundreds of millions of people who are doing this. Well, that's the argument. And on the surface, it looks like it might have some validity. But if you follow the argument all the way through, you should still be buying a cathode tube TV, a chopper bicycle with a banana seat for your kids, and tube socks. The fact is, people's consumption choices change all of the time. Sometimes it has to do with the economy, sometimes it has to do with the fact that there's something better out there, sometimes they just get bored. This doesn't mean that someone couldn't tweak the components of CPI, but frankly, it doesn't look like we're going the way of Argentina anytime soon. By the way, there's another famous economist by the name of Dave Ranson who also questions the viability of the CPI measure. He doesn't believe the government is out to get you like John Williams. He just thinks the methodology is flawed. He thinks a better indication of inflation is commodities, and in particular, the price of precious metals. He said that by the time the product gets to the store shelves, the price of the base commodity, let's just say it's wheat, has affected the cost of the product, maybe even a long time ago in the case of some commodities. This would explain a lot, and it also explains why here, when you come to LBI, things are expensive even if the demand is waning a little bit. This is also probably where people get the idea that if they want to protect themselves against inflation, they need to buy gold. I will note that the price of gold has gone down 5.5% over the last 12 months, while CPI has gone up 9.1%. There are other less common measures like the Big Mac index. What does a Big Mac cost today versus 12 months ago, etc. Let us know what you use for your inflation index in the comment section below. And if I mention it in a future video, I'll mention you as well. Last but not least, check out my video on why 25% of Americans are postponing retirement. This is Jeff Schmidt. Thanks for watching.